Hey everyone, let's jump straight into this explainer. Today, we're unraveling a massive, almost confusing disconnect hiding in the financial metrics of Regeneron Pharmaceuticals. They're a huge player in the biotech space, but right now, the numbers are telling us two completely different, wildly conflicting stories. It's honestly a fascinating puzzle if you love digging into the data as much as we do.
So, to figure out why this stock has been down over 9% year to date, here's our agenda. We're looking at the price versus value disconnect, then we'll decode their valuation multiples, check out their profitability and financial health, evaluate historical stock returns, and finally, give you the final Regeneron verdict.
All right, Section 1, the price versus value disconnect. Let's see how this mystery builds right from the very first numbers we look at.
As of our data, Regeneron's last close price sits at $698.25. Now that reflects a pretty noticeable recent slump. Actually, if you zoom out a bit, the stock is sitting nearly 15% below its 52-week high. For a company of this size, we're talking a market cap over $73 billion. A pullback like that definitely makes you sit up and pay attention.
But here is where it gets incredibly interesting. The calculated fair value price, based on discounted free cash flow, is a whopping $1,748.43. I mean, just take a second to let that sink in. The stock is trading under $700 on the open market, right? But the actual physical cash the business is generating tells us it should be valued at over $1,700.
Which brings us to this. That leaves us with a massive 60.06% margin of safety. In the world of fundamental analysis, a margin of safety that large is literally screaming for attention. It means the stock is trading at a severe discount to the cash it produces. So, we're forced to ask, what on earth is the market seeing that we aren't? Why is Wall Street hesitating to buy into this absolute cash-generating giant at such a steep perceived discount?
Well, to answer that, we really need to look under the hood. So, Section 2, decoding the valuation multiples.
Okay, so the crucial takeaway here is the sheer contrast between these metrics. A price-to-earnings, or PE ratio, of 17.02, that seems totally reasonable, honestly even a bit cheap for a major biotech firm. But drop down to that PEG ratio of 3.89, yikes! That tells us the market is deeply, deeply concerned about their future growth rate. You see, a PEG ratio factors in growth, and anything up near 4 is a massive red flag that growth is stalling relative to the price. Throw in a price-to-free cash flow ratio near 20, and the whole picture gets incredibly complex.
And this brilliantly illustrates the divide we're talking about. Look, if you value the company purely on the free cash flow it generates, it's worth over $1,700. But if you look at their earnings per share, the actual bottom line accounting profit, the fair value just plummets down to $767.54. That leaves just a 9.03% margin of safety from its current price. This right here, this is the heart of the disconnect. The raw cash is flowing beautifully, but the official earnings per share are telling a much, much more pessimistic story.
So, is the core business actually in trouble? Let's pivot to Section 3, profitability and financial health.
While the numbers say absolutely not, their operations are just incredibly lucrative. I mean, with a gross margin of 86.34% and a net profit margin of 31.30%, Regeneron is an absolute cash-generating machine. Think about it. Keeping over 31 cents in pure profit for every single dollar of revenue they bring in is a stellar metric. Most companies can literally only dream of margins like that.
Furthermore, their balance sheet is practically bulletproof. They boast this unbelievably low debt-to-equity ratio of just 0.09. That basically means they barely use any debt at all to finance operations. Combine that with a robust current ratio of 3.57 and a quick ratio over 3, and they've got massive, overwhelming liquidity to cover any short-term obligations. From a purely financial standpoint, this company is an absolute fortress.
So, if the margins are that high and debt is virtually non-existent, how has this actually played out for shareholders? Let's check out Section 4, Evaluating Historical Stock Returns.
Now, this timeline reveals the core issue the market is reacting to. While long-term 20-year investors enjoyed a phenomenal 22.15% average annual return, that momentum has, well, it's completely broken down. 10-year and 5-year returns cooled off into the 6% range, and recent investors have really felt the pain. Actually, if you bought in 3 years ago, you've suffered an annualized decline of negative 2.63%.
The narrative tension here is driven entirely by conflicting growth metrics. I mean, just look at this stark contrast. Their earnings per share has shrunk by an average of 7.72% every single year over the last 5 years. Yet somehow their free cash flow continues to grow at an impressive 14.47% over the last 3 years. The market loves bottom-line earnings growth, right? And Regeneron simply hasn't delivered that recently, despite raking in actual cash hand over fist.
Okay, let's bring all these pieces of the puzzle together in Section 5, the final Regeneron verdict.
You are looking at a classic fundamental standoff here. On the incredibly positive side, we've got pristine balance sheets, virtually zero debt, 86% gross margins, and massive cash flow, pointing to a $1,700 fair value. But then, on the deeply concerning side, we have shrinking earnings per share growth, a punishing PEG ratio, and negative stock returns over the last 3 years. The foundation of the business is rock solid, for sure, but the growth engine, at least when measured by traditional earnings, appears to be sputtering out.
So as we wrap up this explainer, I want to leave you with a crucial question to consider for your own analysis. When the numbers clash this hard, when a fortress balance sheet meets a negative growth trend, do you trust the underlying cash flow or do you trust the current market trend? It's a brilliant reminder that investing is rarely black and white. Thanks so much for joining me for this deep dive, and as always, keep asking the right questions.